There are actual studies out there showing credit scores can literally predict how long you are going to live. It's basically an HP bar for your actual life. I understand credit scores can be complicated, but I'm here to oversimplify how credit scores work so anyone can understand, and you can take back control of your financial health. I'm going to be splitting this video into the 5 factors of a credit score. So the 5 factors of a credit score are payment history, credit use, credit age, types of credit, and new credit. But these 5 factors are not considered equal. The most important factors are payment history and credit use. The other factors are important, but not that big a deal. It's like if you decided to fry an egg. Payment history and credit use is like the egg and the heat to fry the egg. Those things are necessary if you want to eat a fried egg. Whether you use a pan to fry your egg in or other toppings is up to you. Like putting pepper or sriracha, which would be like the other factors, credit age, types of credit, and new credit. They are nice to keep up and have, but not the most important parts of the meal. You could do without, but it would just be disappointing without it. Just to survive though, you'll be fine-ish. So let's do this. I'll explain the most important factors first and work from there. So payment history is sort of like, let's imagine you wanted to borrow money from a friend, because maybe the new boy band BLT concert is coming to town, but you just don't have enough money right now to get the tickets. But you will in the future, you think. You beg and plead to borrow $100 from your friend, and promise you'll pay it back by the end of the month. Your friend gives in and lends you the $100. And what you want to do is, by the end of the month, actually pay your friend back, because you did promise to have the $100 by then. And you do actually have the $100 before the end of the month, and you pay your friend back. Everything is square, and your friend trusts you more. So maybe next time, if you need money for a new pair of Nikes, for example, they might actually let you borrow money from them again, because last time you paid the money back. No problem. But let's say you didn't pay your friend back the $100 for some reason. Maybe you bought too many bubble teas to reach the 10th punch so you could get a free drink. And you didn't keep track of your money and couldn't pay your friend back. Why would your friend ever lend money to you again? They wouldn't, or at least I wouldn't. Because last time you promised to pay them back, you didn't. That's sort of how payment history works. It's the biggest factor in your credit score. It makes up 35% of your credit score. And of course, the longer you take to pay the money back you borrowed, the more hurtful it is to your credit score. 1 or 2 months late is pretty bad, but being 3 months late or longer is very, very bad. Some banks won't even consider lending to you if you're 3 months late. So even if you are late with your payments, still try your best to pay it back as soon as you can. The second most important factor towards your credit score is credit use. So think about this as going to Olive Garden. Yes, when you go to Olive Garden, you can technically order everything from the menu, because when you're here, you're family. But honestly, if you order more than 2 or 3 full meals for yourself, people are gonna start to look. The 6 plates of cheese ravioli and the 2 plates of my favorite chicken alfredo are already suspicious, but you want more? And your server might just happen to be busy or disappear and watch you from a distance just to make sure you don't dine and dash. This is sort of like credit use, which makes up 30% of your credit score. Just because a bank lends you $5,000 to use doesn't mean they want you to use the full $5,000 without paying it down. Because they see you more as a risk, because they are afraid you can't pay back what you owe. Usually banks are pretty comfortable at the maximum amount of a 30% credit usage. So let's say you added up all your credit limits from all your credit cards and it's a $10,000 total. 30% of $10,000 is $3,000. If you use any more than $3,000, you might see your credit score start dropping dramatically. The best usage banks are totally comfortable with you using is 10%, because they still expect you to use your credit that they have given you, but they don't see you as much of a risk. Also, this applies to individual credit cards. If your total credit limit across all credit cards is $10,000 and you use only $3,000, that's not terrible. But it's a different story if you have the entire $3,000 usage on just one credit card that only has a credit limit of $3,000. That would mean you are using 100% worth of that credit card, and banks aren't too comfortable with that. It's like if you went to Costco and bought a wholesale box of chocolate chip cookies, the superior cookie, Fight Me, and instead of saving them for the future, you ate them all in one sitting. I would be terrified. That's a crap ton of cookies, even for my standard. For the most part, this credit score factor weighs heavily on credit cards. Loans don't really play too much in the credit use factor. Just pay down what you can, as much as you can, and you should be good. The third most important factor is credit age. I think this one is pretty self-explanatory. Basically, the longer you've done something, the more trust there is, like a romantic relationship. The longer a relationship lasts between 2 people, the more likely you all will trust each other. But like a relationship, every time you break up and start a new relationship, for the most part, there is still some trust you can carry into the new relationship. Because maybe you all talked about your past relationships and your new partner knows you've been faithful for at least 3 years to someone else before, but you still have to start anew. This is a different relationship. Credit age sort of works like this. Having an old account that is open definitely helps, but credit age does take the average of all your accounts. So if you open a bunch of new credit cards, the average age drops. But honestly, it's not that big of a deal. Credit age only makes up 15% of your credit score. The biggest issue I've seen people have problems with this credit score factor is when they don't have any other credit cards or any other type of credit lines that can stay open forever, and they go to pay off a loan like a student loan. Their credit scores dramatically drops because after you pay something off like a loan, it gets removed from your credit score because it's no longer open. And it's the same problem if you cancel your oldest credit card. So as early as you can, in my opinion, try to open a no annual fee credit card, or at least a credit card that you can upgrade or downgrade, thereby never having to cancel it. The two last factors are about the same worth of importance, but still pretty low factors to your overall credit score. The second to last one is types of credits. It makes up about 10% of your credit score. Reminds me of that one person you know that can speak multiple different languages, like they can speak English, Japanese, and French. It's cool they can speak other languages other than English, but it's not that big of a deal. It might come in useful one day if somebody needs help and doesn't speak English, or you travel internationally. But if you stay in America, you might honestly forget your friend can speak other languages. I'm not saying it's not important, but if you had to choose between only focusing on payment history or types of credit, hands down focus all your energy on payment history if you had to decide between the two for some reason. But if you want a perfect or really good credit score, then of course try to increase the types of credits you have, which could be credit cards, a mortgage, student loans, auto loans, or just loans in general. Because having multiple different types of accounts shows you can handle different types of situations and you 100% know what you're doing financially. The last factor that affects your credit score is new credit. Basically the amount of times you beg and ask for more money. Like if you ask your mom for 15 bucks, then you ask your dad for another 30 bucks. Then you ask your brother for another 30 bucks. But your brother overheard you already asked for $45 and is really suspicious why you're asking for money so much, so he doesn't loan you the 30 bucks. He's afraid you can't pay back what you owe to everybody else. The new credit factor is basically hard pulls, which is like applying for new credit cards and loans. Isn't that big a deal to keep up with? Unless you apply for a bunch of new applications in a short amount of time. But after 2 years, hard pulls will fully drop from your credit score, and usually after 3 months doesn't really affect your credit score anymore. And those were the 5 factors that affect your credit score. So does your credit score actually predict how long you are going to live? Kind of. Credit score and lifespan are a correlation. Just because you have a low credit score doesn't mean you're going to kick the bucket earlier. Like if I said during the summer, ice cream sales go up, but car accidents also increase in the summer. Could mean people are eating ice cream while driving, which is very dangerous. But more realistically, it could just mean that it's hot and people are vacationing more. That's why the two happens more during the summer. Same for credit score and lifespan. They most likely don't cause each other, however they can be related. Like having a lower credit score could mean you don't have a high income or a livable income even. Therefore, if you needed to borrow money, you'll have to pay a higher interest rate, which could cut into your budget and cause more stress, mixed in with other stress factors already in your life and cause a heart attack or a stroke. Also, thanks to the issues with our healthcare system in America, people who have a serious medical condition could be maxing out their credit cards and taking out loans to pay for the treatment, thereby skewing the data. So having a lower credit score doesn't necessarily cause the shorter lifespan, but having a higher credit score can definitely decrease your stress levels when it comes to finance. And knowing is half the battle. Does everything make sense? If not, feel free to leave a comment and I'll try to answer it. Subscribe if this video helped you out, and I'll see you later.